Hello there, welcome to this video. Hope you're all doing well. I've just popped to the local town. I've had my hair cut. I'm sitting here for 10 minutes. It's a good opportunity to create a video. Trading is going well for me. Things have really picked up. Price action seems a lot more reliable at the moment. The markets are moving in the right direction, according to me. From a fundamental point of view, the markets are making a lot of sense. They're trending in the direction I want them to trend. So I'm pretty happy. Things are much better now than they were a couple of months ago. I am preparing for a large market correction in US stock markets. I'm preparing for a drop in equity markets. And in this video, I want to share with you why I think that is the case, how it could impact FX, how you can make money from this, how you can prepare for this. So let me share these thoughts with you. I'd love to hear your thoughts, so leave them in the comment section below, and let's get started. The big question is, will there be a US recession? Or another way of wording a very similar question is, will US stock markets fall within the next 12 months? And in short, I believe they will. I believe there is a strong US equity market correction due. And there are a number of reasons for that. Some of them we can see, some of them we can't see, and we won't see them until it's happened and we look back. Obviously, there is going to be some sort of downside move, within the next 12 months. All major equity markets will experience some sort of drawdown, even if it's a small one, within the next 12 months. But I think there is a much larger drawdown, larger correction move due. And the first main reason, I guess the primary reason why I think this is the case, is the US stock markets are so overvalued, incredibly overvalued, so overvalued that I personally cannot see any good opportunities to buy US stocks. So I don't just trade Forex, I also trade futures, and I invest in stocks and ETFs. I just notice my finger is appearing on the screen there. I invest in ETFs and equities, and at the moment I just don't see any good US equity opportunities because the markets are so high. Now let me share something with you. This chart that you're going to see appear on the video here is price to book value. And price to book value is basically a metric to evaluate if a company's shares are reasonably priced. And you can see the average down the bottom of the chart there is around 2, and we're currently 5.3, which is an all-time high, using data going back to 1946. Now, last time we had price to book value ratio so high, following that peak, we entered a 2.5 year bear market in US equities. The S&P 500 fell about 30 to 40%. I think it's about 37%. And the NASDAQ fell about 76%. Markets, US markets, equity markets are extremely overvalued at the moment. Now, I'm not suggesting you should just go and start short selling US stocks, because the biggest issue with bear markets isn't necessarily predicting that they're going to happen or not going to happen. It's when. It could be that US stocks become 6 times the ratio, 7 times the ratio. This peak could move much higher before it comes down. But we definitely have a warning sign that the US stock markets are overvalued and a correction is due. We need to move down nearer that 2 level on that chart. US stocks are simply just too expensive. There are so many articles, investors, and there are even banks. And this kind of moves on to my second point, why I'm bearish the US stock market, is even banks are now coming out, investment banks, and saying that a correction is due. And notably, the most notable banks, Goldman Sachs, Morgan Stanley, recently, just within the last month, said they're expecting a major market correction within the coming weeks and months. And it's all based on this overvaluation. They're just far too high. When you look at any US stocks, any of the major players, if you look at the price action, it just seems like euphoria. They're just so high. They're priced so expensively for what they are. Now, something else to look at is this chart that's going to appear on the video now. So this is from a website called Current Market Valuation. It's a really interesting website. I suggest you check it out. And they have 6 sort of indicators to value markets, and all 6 are currently overvalued, and 4 of them, so 4 of the 6 are strongly overvalued. And this is the Buffett indicator that you can see on the screen now. So once again, I'm not suggesting just go out and sell everything now, and I can't give that financial advice either. You know, you need to follow a financial advisor before following anything I say in these videos, because I could be talking a load of rubbish. You know, I could have it completely wrong. So don't sue me if there's not this market correction within the next 12 months. But these warning signs are there. You know, it's going to happen at some point. It can't continue the way it is. Now, there's another reason why I think there's going to be a bear market, a downside move in US equities. And that is based on the amount of debt and falling cash levels that a lot of US companies have. And I'm talking about some big players here. Apple, Walmart, Costco, Cisco, Procter & Gamble, Oracle, United Health. A number of these companies have unhealthy current ratios. And what a current ratio is, it compares a company's current assets, its short-term assets, its liquid assets, cash, stock, money owed from debtors, that sort of thing, against its short-term liabilities. So what they have in the short term against what they owe in the short term. And a healthy current ratio is that there's always enough cash and liquid assets to cover short-term debt. But that is not the case with those companies I've just listed. And that's just a small portion of them. So many US stocks are at all-time highs and have poor current ratios. They're unhealthy. Now, I'm not suggesting that any of these companies that I've mentioned or any of the others will go bust or default on debts or anything like that. I'm not suggesting that. But what I am suggesting is if there is a spanner in the financial works, if sales drop, if debtors are not paying them, then I believe that cash flow is going to become cash flow will become extremely tight for a lot of these companies. There'll be lots of cash. And what does that mean? That means they either borrow more or they have to start laying off staff, which then is a catalyst into recession, isn't it? It fuels that recessionary fire. So that's the other thing that's put me off buying US equities and also starting to become bearish on US equities. Now, I'm not someone who short sells stocks, individual stocks, but there are ways you can make money from a downside market, which I'll go through in a moment. Now, I've got one more thing I want to share with you, one more slide's going to appear, and that is the S&P 500 here. You can see it's been moving within this large weekly channel since 2020. So from a technical point of view, price is reaching that channel resistance area. So if you want to ignore the fundamentals, if you're not bothered about price to book value, if you're not bothered about current market valuation tools or US stocks being too expensive or current ratios or what Goldman Sachs has to say or Morgan Stanley has to say, If you're not interested in any of that, then purely from a technical point of view, we are reaching a key level of resistance. So bear that in mind too. So they're my reasons, and there's more to that that I'm not going to share in this video. There's also a lot of reasons why price may move higher, why the stock markets may continue to climb higher. But definitely from August 2025, which is the month I'm recording this, I have started to prepare for this correction move. And like I said earlier, I don't know when it's going to happen. It might be in 12 months time. It might be in a few months time. I don't know. But I am preparing for it. The hardest thing is knowing when, not necessarily why. It's when. It's the entry. It's when it's going to happen. But anyway, I'm starting to talk a bit too much now and get distracted. This car park is very busy. I'm getting very my eyes are getting very occupied by all the things going on. Okay, so how do you prepare for this, and how do you make money from it if there is this slide in US markets, US equity markets? The first is to lower your risk by lowering your exposure. So if you do hold stocks, it doesn't necessarily have to be just US stocks, because if US markets fall, that will spread into other equity markets. So be aware of that. So the first thing to do is lower your exposure, is to lower your risk. So mid-August 2025, I actually closed down all of my equity positions, all my UK and US equity positions, all the stocks and shares I held, I have closed down. I'm holding my long-term investments, such as my equity ETFs. I don't feel there's a need to close down like long-term investments. We ride the peaks and the troughs, don't we, with those investments? But for short-term investing, for trading, I've closed down all my equity positions. I'm not suggesting you do that. This is not financial advice. Like I said, markets could continue to move higher for the foreseeable future, and you could miss out on some upside moves. But for me, I've closed down my equity positions because I think that correction is going to come. And if I don't have exposure to that, all good for me. So the first thing to do is really to lower your risk. If there is a big move coming, be prepared for it. And the best way to be prepared for it is not to have positions open that will take a hit, will take a loss from that downside move. If you are leveraged with equities, especially if you're long leveraged equities, then perhaps reduce that leverage or get rid of it. Do not trade on margin. How do we make money from this? Well, the first thing is have funds available to buy. Or someone's blasting their music. You might hear that in the background. It's a bit early for some dance, drum and bass. But each to their own. What was I saying? Yeah, have funds available to buy at these lower prices. So if there is a correction move, historically, all US major indices have recovered from corrections, from crashes, and have climbed higher. That's not a guarantee that it will happen again, but historically it's always been the case. So if prices do fall, have funds available now in preparation for that, so you can buy at lower prices. You can buy at these low prices, these correction move prices, and then make money on the recovery. I am not a short seller. I do not short sell specific stocks, single stocks, but I do short sell indices, and I have been short the S&P 500. I was also short the Russell, but that's now closed. I'm short the S&P 500, and I have been since the middle of August 2025, and I'll continue to look for shorting opportunities over the next 12 months until I see the correction that I'm expecting. So if you are outside the US, if you're in the UK, Europe, Australia, you will have access to CFD, spread betting, that you can easily short sell any equity indices. But let's move into Forex. Now, how will this impact the Forex markets? Historically speaking, typically what happens in times of concern, worry, you'll see a stronger dollar, a stronger Swiss franc, and a stronger yen. They're the three to buy, and dollar is king. Buy the dollar. That's always the obvious one in times of crisis. But there is a disclaimer with this, and that is, or disclaimer is not the word that I want. I can't think of the word that I want. It's too early. There is something I want to say with this, and that is, there is a possibility that the US stock market correction is the market. Let me rephrase this. I'm getting into a muddle. There is a possibility that the market correction, the equity market correction, is isolated to the US, because I don't see European stocks and other stocks as overvalued as the US. Saying that, if there is a downside move in US stocks, we're going to see that globally, because they mirror each other. But I wouldn't be surprised if we don't see as much of a move in global stocks, that it is isolated to some degree in the US. If it is isolated, then the dollar won't be the buy. Generally, in times of global crisis, the dollar is king. But if the crisis is isolated to the US, then dollar isn't king, and you might actually see the dollar sell off. So just be aware of that. But I think buying the yen is the obvious one. You have interest rates slowly rising. If there was some sort of recession or market correction that caused concern, the yen seems like the safe haven. And I think the Nikkei, the Japanese stock market, has performed pretty well too historically in these times of uncertainty. Okay, I think I've said enough. I made this video long enough. Thank you so much for watching. Any thoughts that you have, leave them below. I'll be interested to know what you say. Obviously, there'll be people who are bullish the market and could be right. I could be talking a load of rubbish. But hey, this is what it's all about, isn't it? It's investing and trading. We have our opinions. Sometimes they work, sometimes they don't. Okay, thanks for watching, and I'll speak to you in another video.